Good afternoon and welcome to a special asset management webcast for Livingston at Laurel Hills, hosted by Investors Management Group. Presenting on today's webcast are Michelle Rivnak, Managing Director of Asset Management, and myself, Dave Mickelson, Investor Relations Manager. Thank you for making time to join with us today. The schedule for this presentation is a little out of the ordinary, as we just hosted our first quarter webcast last month, and we generally only host a call every quarter. But plans for the special webcast today came about because the real estate market and the national economy have been so impacted by the COVID epidemic, and we thought that it would be a valuable time to update you on your investment performance between the first and the second quarter calls. So with today's special presentation, we'll make that shorter than a quarterly call as we've condensed the material that we'll be covering. We'll review a sensitivity analysis update, property reserves, collections, and news. That'll be similar to our reviews of those topics in the past. Then a new subject for today will be the 2020 budget reforecast. That reforecast will combine an assessment of actual operations to date with how we see the balance of the year likely to play out.
Kathy!
One note that I'll make here is if we could put the lines on mute, that'll ensure a better audio quality for the whole presentation. Another thing I'll mention here is that Michelle and I will look forward to responding to any questions in the question and answer session as we close the webcast. So if you'd like to submit a question, you can send that either through the live chat pane if you're in the GoToMeeting application, or you can send an email to me at david.mickelson@imgre.com, or also to investor.relations@imgre.com. I'll collect questions through the presentation and we can address those at the end, but in the meantime, we'll keep the lines on mute. Appreciate that. So with that introduction, I'll move into the first set of slides to discuss our break-even sensitivity analysis. So this will look familiar to you for those who joined in the first quarter call, and as a quick refresher, I'll just point out that the goal with this analysis is to gauge what the property income collection rate needs to be in order to break even, or in other words, what income we need to pay all of our operating expenses, our debt service, and our capital improvements. So income collections have been a daily focus of the asset management team, and it's been a key statistic that we've tracked for all of our properties daily. And you'll see how that works here on this sensitivity analysis as we speak more about collections in this presentation. So in the left-hand column, you'll see historical averages for income and expenses. This becomes our baseline. In the middle column, you'll see our sensitivity test 1. This was the break-even that we presented to you back in April. And if you're looking at the bottom half of that column, you'll see an effective interest rate at 3.21%. That assumes a 30-day LIBOR rate at 1%, and then that computes to an annual mortgage interest payment of about $599,000 a year. So with that debt service expense and our other expenses, the income that we need to break even is about 73% of average. Now in the right-hand column, this is our sensitivity test updated for May. The big change here was in the interest rate. You'll see that that dropped by 50 basis points, and that's in correspondence with how the LIBOR rate fell between April and May. With that reduced debt expense, now our net collection to break even arrives at about 69%. So we benefit definitely from that as our cost of debt drops. If we move to the next slide, we can review some of the assumptions for the analysis and kind of what it means to us here as an investor group. So again, for April, 73% is the magic break-even income collection rate. We've assumed that operating expenses decrease a little bit with some of the property management fees and the asset management fees because those are tied to our income collection. And then some of the operating expenses increase because we assume that utilities expenses would go up. With the lower interest costs, now in May, our break-even is about 69%. And what that translates to, even in that 50 basis point reduction in interest rate, is almost $100,000 in annual debt service savings between the May and the April sensitivity test. Now, also as a side note, the LIBOR rate has dropped even further since the beginning of May. As of yesterday, that rate was at 17 basis points. And so if the rate continues to hold low, and it is projected to stay below 20 basis points through the rest of this year, we should continue to benefit with even lower interest expenses in future months. So for the next measure of the investment, let me turn it over to Michelle, and she can review the Livingston property reserves.
Thank you, Dave. Here we have a high-level reserve summary, and it's split into two different groups, owner-controlled and lender-controlled. So our operating account, you can see, has a balance of $545,000. The capital reserve account is at $911,000. The total owner-held reserve is $1,456,496. Below that, you'll see the lender-held funds, and that replacement reserve is at $191,000. The CapEx reserve is at $1,391,000. And then there's a combined account for taxes, insurance, and rate cap escrow, and that account is at $125,106. The total sitting with the lender is $1,707,538. Now, just to make a note here, the capital and replacement reserves are draw accounts, so we need to spend that money to draw on it. We were holding on to some of our bigger projects at Livingston because of our COVID environment, but we're really confident in the operations, and we'll get those projects up and running. We've got some things already in the approval process and moving forward. So we'll update you on those projects as they happen, but I just wanted to give you that background on those amounts. The total reserve for lender held and owner held combines for $3,164,000. So that gives you that snapshot there of our reserve summary. I'd like to take you into the next bit of information is the collections. As Dave mentioned, we are, diligently checking this on a daily basis. So I'd like to show you what May looks like and then how April ended up. So for May, this information is as of last Friday, the 22nd. For rents, you can see that we've billed $188,209. Of that, we collected $178,259, which is 95% collected. We do have other income at $13,163. You combine that with the rent, we have a total collection of $191,422. That is that break-even number that we're looking at there, the $135,088. So we surpassed that we're at 142% of break-even, or a difference there of $56,334. And if you look at the April numbers, you can see that we were 96% collected by the end of April on rent, and an additional $13,000 again in other income. We're sitting well occupied at 96.8%. We do have 7 people on payment plans. That's just our tool to keep our residents engaged. Anyone that was not able to pay their rent in full, this has a commitment to us to go ahead and make payments so that they're taking care of those past due balances. As the last line here, you'll see as of May 22nd, Livingston actually collected an additional $3,840 of April rent money in May. That's not included in the May numbers. We are tracking that separately, but I wanted to just give you that note because truly what happened in April is we didn't collect 96%. It went up to that 98%. So that gives you a little bit of our collections and what's going on daily, our reserves of what we have in the bank. So how does that all tie together then with our new environment, the new laws and restrictions that we have in place in our operations, and how does that kind of unfold compared to the original budget that we had in mind? So I'd like to kind of walk you through this income information so you can see kind of how we are laying this out for you. The first block of information you're seeing there is January through April 2020. If you look at that bottom line, you're going to see total income. The total income variance that we had January through April was positive $9,185 or 1.2%. This middle block, what you're seeing is our reforecast numbers. So we're showing those go down. And let me walk you through the main drivers there. On our top line, we've got total potential rent. That is being decreased by 3.5%. That's mainly due to not doing interior unit renovations during this time. Our renters are being very cash conscious, and we want to make sure that as we spend that money to renovate unit interiors, we are able to realize that lift on those rentals. So at this point, we've mocked one up. We know what it's going to look like when we're ready, but we're not going to pull that trigger until we see the demand in the market. We'll be evaluating it month over month, but that's where you're seeing that 3.5%. Bad debt is also estimated to go up by about $29,000. We are in a situation where we're not able to evict anyone. So anyone that has bad debt is able to build quite the balance before we'll be able to evict them. And, that's going to be a July, August, perhaps September as these laws lift. So we'll keep an eye on that one as well. If you take all of those kind of things combined, if you look at the positive variance we had of 9,000 and add that to the downward shift of the 5.1% or 83,000, we're expecting our total income to come in by the end of the year at about 3% under our budgeted expectation, which is $74,367. So that gives you kind of the overview on income. So I'd like to keep that number in mind, that variance, as we walk it through expenses. And I won't take you through all of these, so we'll just focus again on that bottom line. You can see that as we came out of April, we were positive. We did have actual savings in total expenses of 9.2% or $30,820. As we continue and reforecast, we're expecting savings, maybe not at that level. Some of this is just timing, things that we are expecting to pay at one point in the year will be pushed to another. So you're seeing savings, but in the amount of about $9,824, 1.4%. So if you take those two positives together, the 9,800 and the 30,000, that combines for $40,000 in savings, or 3.9% by the end of the year. So that will help to offset the that negative number that we saw in income on the last bit of information. So we've got the income, we've got the expenses. So how does it net out? So let's walk you through net operating income. We did have savings in the beginning of the year in expenses. Our NOI, we ended April, was ahead of the game 9.1% or $40,000. We talked about seeing income go down, but offsetting that with some savings and expenses. So we're seeing a reforecast of down by 7.9%. So as it nets out, we will see, we're expecting net operating income to come in under budget expectations by about 2.4% or $33,000. The next line is debt service, and Dave just gave you great information on that. So I won't go into those details, but I'll just show you how the big number is affected here. We did have a positive variance coming out of April as the rate was already starting to drop. That was $23,000 in savings. We expect over the rest of the year, as we watch this rate stay so low, we're estimating another $150,000 in savings. Combined together by year end, that's close to $174,000 in debt service savings. So these other two columns aren't as impactful. Asset management fees definitely will be lower. That is tied to income on a percentage. other partnership fees. There was less travel in the beginning of the year so far, as we had that positive variance there. So our net number at the bottom, you'll see as we came out of April, on our net income, we had $68,000, or 42% to the good. Our reforecast showing the combined decrease in income, savings in expenses, and savings in debt service show a positive number, 74,291, or 18.4%. So if you combine those positive variances over towards the end of the year, you'll see that we are expecting to come in above budget expectations by 25%, or $142,000. So it's a lot of numbers, a lot of information. It is our reforecast, and we're expecting some of these numbers to change. We won't have a webcast for you next month, but we will go ahead and update this reforecast so you can kind of follow along on how things are changing. We will add the May actuals when we finalize those financials in the middle of June, and have this up for you by the end of June to your portal to take a look at. Parts of what we're watching and what we're seeing as things change so much is our kind of current events and news. And I just want to walk you through a few things going on in North Carolina as a whole. This impacts if our residents are able to go back to work and how unemployment benefits are coming out. So they had stay-at-home orders strictly in place until last Friday, the 22nd. So that ended phase 1. They are now in phase 2, going from stay at home to safer at home. That is expected to run all the way through the end of June, the 26th. They're having limited things open, some restaurants and retail at a limited capacity, but larger venues and anything, nightclubs, bars, theaters, things like that are still closed. Their child care facilities are opening, which is interesting to watch in case that was prohibiting somebody from going back to work. And then 2 just pieces about unemployment. Since the middle of March, North Carolina has received about 960,000 claims. It's about 20% of their workforce. Quite a few have been paid, but we still have about 300,000 claims that are unpaid. Some are 2 weeks old, which is their goal from claim to pay, and then some are a month, some are 2 months old. So there is a bit of a struggle there in North Carolina to get all those payments out, and that also includes the additional $600 federally backed unemployment payments. So we'll be tracking that as you know, all the news and everything goes on, and as we look at your reforecast numbers and change those. One more bit of information that I have for you is about owner distributions. We were set to begin distributions in April until all of this unfolded. We weren't sure what was going to happen, but we've had strong collections over the last 2 months, and we do have sufficient reserves. So we will begin the distributions in June. That's at a 6%. If anything changes, we will be sure to let you know. We will constantly be reevaluating the property operations and the environment. So if anything changes, we'll let you know. But as of right now, our distributions will begin again in June. And that is my update for you. And with that, I will hand it back to Dave.
Fantastic. Thank you, Michelle. Well, that brings us to the end of our prepared webcast slide presentation. We haven't received any questions through chat or email, so I'll close the call here, and I'll invite you to send any questions directly to me or to Michelle or Carlin if those come up in the future. I'll also make a note that we'll post this audio recording of the presentation and April reports to your portal in the next few days. And then we've mentioned our second quarter asset management webcast. That'll take place the last week of July, and we'll send announcements and reminders as we get closer to that. Well, this will conclude our special asset management webcast for Livingston at Laurel Hills. Thank you for your partnership. We'll talk again soon. Have a great day.